All right, today is Friday, July 31st, the last trading day of the month. This is a stock market review for the market activities today. The indices closed in the green. The Dow Industrial Average closed 114.67 points or 0.44% to the upside. The Nasdaq, of course, was the overperformer today again, up 157.66 points or 1.5%. S&P 500 closed about 25 points to the upside or 0.77%. Let's take a look at the futures. The futures, we saw gold and silver recovering, silver specifically recovering, but gold continuing the march to the green skies. Nothing can stop gold now. Gold continues to catch a bid. And of course, that is a result of many factors: the weakness in the dollar, the weakness in yields, the continuation of gold purchases from foreign central banks, specifically China. And of course, it is a safety play for money managers who are taking profits in stocks and moving those profits into gold instead of cash or bonds. Other precious metals like platinum and palladium rebounded just a little bit from yesterday's sell-offs, but not by a lot. Copper was down a little bit. Oil prices, of course, recovered. They started down and then they recovered, rebounded by the end of the day. The US dollar also caught a bid, just a small bid, a little rebound, a little pause. We'll see what the United States dollar wants to do in the days and weeks to come, but the most likely scenario is we're going to see more weakness. We saw a rebound for lean hogs. That's about time. It's very good for our ranchers and farmers. We need to see lean hogs prices trending higher. Of course, the lean hogs futures sold off at the end of the month because of the contract expiration, so we will see if that will recover in the contract for next month. Coffee, sugar continues the march to the upside. They've been bullish for a while. They will continue to be bullish. Now, looking at the heat map, the picture is very clear. We're looking at a muted picture to a red picture across the heat map, with the exception, of course, of the three tech giants that reported yesterday: Apple, Facebook, and Amazon. And the picture was actually more negative in the morning. The market was trading in the red overall, more than you see in this heat map of the closing bell. But we saw a stampede in Apple shares around 11 o'clock Pacific, 2 o'clock Eastern, where the fear of missing out, the stampede because of the stock split, of course, attracted very large volume of buying in Apple stock. Apple has a large weighting, as you can see, on the overall market, so it acted as the tide that lifted all boats. I made a video in details going through Apple's earnings, and my stand is bearish compared to the Main Street look. I see the shares buyback, the stock split announcement as a distraction from the true story, which is the highest margin business in Apple. The wearables and the services trended down for the first time and deaccelerated. Plus, the new iPhone is getting delayed, and the question about the demand for the new phone, whether the demand will meet expectations or not, because why would you upgrade right now if the last phone is working fine and there is no 5G announcement, especially when you combine the fact of the consumer purchasing weakness across the globe. If you want to hear more details about my analysis of Apple's earnings, you can watch that video. It is on my channel. But as expected, of course, the stock split 4-1 generated some excitement and huge demand for people to reserve their seats in the stock before the stock split. Of course, the stock split will not affect your shares in any way possible. You're still going to have the same stake. If you have 50 grand invested in Apple, you're still going to have 50 grand invested in Apple. The only thing that will adjust it is the prices and the shares. If you have 100 shares of Apple, you bought them at $400. After the split, you're going to have 400 shares instead, but your entry price is going to be $100. So all in all, the stock split does not affect you and me at all. However, it is a psychological factor. People think that there is something positive after the stock split and they will have more shares and the stock will move in bigger moves like it used to before the split, and now they will have more shares to play with. That is a false narrative, of course, but the management, of course, knew that ahead of time. They wanted to create the psychological fear of missing out phenomenon and for people to stampede and buy Apple stock and to distract from the real story of certain slowdowns in the services and the wearables business. And of course, the increase in growth in Apple last quarter came from Macs and iPads due to the upgrade cycle for the stay at home, working, and going to school environment. People going to school from home, working from home. They need new Macs, they need new iPads. Tim Cook himself said that they did some contracts with certain schools, supplying them with iPads. This is an upgrade cycle for 1 quarter. They buy it for the semester or for the school year. And that said, you're not going to see that happen again. So the question is, what will be the driver for growth in Apple stock in next quarters? For now, that doesn't matter. Of course, the question was always, where will Apple growth come from? But the answer was share buybacks is the most important thing. It's what's lifting the stock. And now what's going to lift the stock for the days and weeks to come is the mania of the stock split, the fear of missing out. You will see a stampede for people to reserve their seats. Let's take a look at some of the other earnings we had yesterday. Expedia, this is a name that I shorted about a week ago. The revenue is down 82% in the last earnings, and of course the stock reacted negatively today. There's a lot of pain in the travel sector. The CEO came on CNBC and tried to play it in the positive side, but the picture was clear. Travelers are nowhere to be seen here. We also have more details on Google's earning. Google, of course, was the underperformer among tech giants today. The reason is they reported a decline in revenue for the first time in the company's history. Amazon reported a huge quarter, massive number of profit and revenue. Absolutely unbelievable number, specifically the revenue number that a company creates over $80 billion in revenue in 1 quarter. This is what small countries make in a year. But the excitement was tempered, of course, because the AWS, the highest growth unit in Amazon, deaccelerated again. We saw that in Microsoft. Now we're seeing with AWS. Therefore, you saw Google trending red. Amazon pretty much stayed flat, opened at around 4%, remained flat throughout the day. Facebook opened at around 7%. Facebook had the cleanest beat here among the tech giants. Clean revenue, organic growth, year over year, no problem whatsoever for Facebook. Facebook opened up around 7% and traded to that range all the way to the closing bell. Apple was a story here, opened around 5 to 6% of the upside, and then it doubled, closed over 10% because of the stampede that happened in the afternoon, and I will show you that in the chart specifically. We had more earnings before the bell from Exxon. ExxonMobil said that this is the worst, or reported the worst loss in modern history. They're, of course, trying to save dividends, so they're cutting jobs as well. What about Chevron? Of course, if you've been following me, you know that I started a small position in Chevron, and I'm waiting after earnings to see if I will add to it more or not. My thesis of buying this stock, of course, to be a dividend play. But most importantly, Chevron outperformed in the downstream business last quarter and it underperformed in the upstream business. It is mostly a downstream business. This is why I chose it over the upstream players in the oil sector. Also, the dollar will act as a positive factor. The weakness in the dollar will act as a positive factor as oil prices go up. So will Chevron revenues. And of course, the majority of their reserves are overseas where countries are recovering and reopening. So operations are going back to normal in these overseas wells. That was my thesis at least. But today when the earnings were announced, my thesis went out of the window. It was gone. Chevron reported the worst loss in decades. And of course, what made up my mind to nip this in the bud and move out from Chevron is the CEO himself. The CEO himself says the results are going to be depressed for quarters to come. And they're scrambling, of course, to save the dividend. They're cutting costs to save the dividend. It is a dividend play at the end. But when a company CEO tells you, hey, there's nothing here, take your money, go somewhere else, don't invest in my company, that's what the CEO, not so many subtle ways, said during the earnings call. For me, that was it. When the CEO bails out in his own company, I'm out, taking my money, going somewhere else. We also had earnings from Merck. Merck raised outlooks. They actually had very good earnings. The revenue declined a little bit, but it was saved by an acceleration of sales in the Keytruda anti-cancer drug continues to outperform and becomes the main driver of growth in Merck. Merck, Pfizer, the big pharmaceutical companies are stable and will continue to outperform. The more speculative names in pharma and biotech I will stay away from because they're very vaccine dependent. Any bad news in their vaccine trials and they will crash. But the big biotech and big pharma names will remain stable. What about Caterpillar, another industrial giant? We've seen earnings dive over 70% year over year. Not a good look for Caterpillar, but of course it is expected in the current environment. Let's take a look at some headlines here. Of course, there's the circus that's going on right now in Washington, D.C. about the stimulus. It's all about the stimulus, and we're going to see that circus continues for a little while. But here is Trump, of course, wants to give more than the $1,200 checks that they gave before. They want to give a little more. I don't know if they're going to give $1,500. 2000. Frankly, this is trying to bribe people before an election. That's what it is, really, in a nutshell. I'll take the check, no problem. I'm not sure if I'll vote for him or not, but I'll take the check, and I'm sure most of you will take the check, no problem, if it is more than $1,200. We also have the government watchdog saying that there's strong indicators of fraud in the PPP loan program. Finally, we have a watchdog looking over these very scandalous and fraud transactions in the PPP program. Let's now take a look at the charts, see how the charts closed, what we can learn from them. The SPY, the S&P 500, struggled a little today earlier, but then it rebounded because Apple was the tide that lifted all boats and managed to close above the resistance line. It managed to close above the double top that we have identified earlier. It did close below the July 23rd high. That is the only negative thing here. But all in all, this is a very bullish close. You cannot have two ways to look at it. It is bullish. It recaptured the resistance line. It continues to trend up. It doesn't want to go down. These are all bullish behaviors. Let's take a look at the 15 minutes chart here. As you can see, it sold off in the morning, and then as the stampede in Apple happened, we saw all indices being lifted. The SPY is no exception. What about the weekly close? The weekly close is mixed. It is, looking at it from the grand scheme of things, very bullish. However, we closed a little below last week's high. And of course, we had the artificial inflation at the end of the day because of Apple. We'll see how will that factor in the next week for the SPY. How about the Qs, the most important name of the day? It closed to the upper line of the channel that I identified, the downtrend channel. It's closing above it. We need to see it trend above it and close above the channel. That would be very bullish for the Qs. Of course, they didn't make it today, but we'll see what happens next week. From a 15 minutes perspective, you can see the U formation, the W, but I call it U. It's more of a U. It started selling off in the morning, and then it caught a bit at the end because of Apple, of course. It didn't close at the highs of the candle of the reversal in the beginning, but it closed very, very close to it. Let's take a look at the short triple Q, the reverse triple Q. This is a name that I have a position in, and I released this tweet in the morning. I added in the morning. I added in the close. I'm trying to average down here my entry price for the short triple Q. As you can see, it trades just as the mirror image of the Qs. It has the reverse U formation. It started catching a bit in the morning. It even peaked, managed to peak to the green, and then reversed as Apple, of course, caught the stampede and then trended lower. But I added at the close and the open. I want to average my position down, and I maintain that the pullback in technology will happen because look at what happened to Amazon. It was pretty much muted after the earnings, up 3%, but still muted. Google, you saw what happened to Google. Apple was different, of course. The stock split news that will act as a secular driver for Apple and for the Qs temporarily. But in the grand scheme of things, we will see the air come out of the bubble a little bit, and you'll see a sell-off in the Qs and the technology sector happening, and those short triple Q position will appreciate significantly. I also urge you to use the muted action in the VIX to accumulate options positions, calls or puts. They're very cheap right now. If you like any calls or puts in any names that you've been watching, this is the time to buy them. I did buy some puts in the LQD, this is the investment grade corporate bonds, and the XBI, the biotech sector. I think we're going to see a little bit of softening here, a little bit of a sell-off, continuation of the downtrend for a little bit, not anything significant. And of course, the IGR is the small cap index. We started seeing weakness in the small caps, and I think that we'll see more weakness in the weeks to come in small caps. Again, nothing significant, just a little bit. This is basically taking advantage of very, very cheap option prices. If we start seeing big moves in the market, specifically in the downside, these names will appreciate significantly because your entry price in the option was very, very low, and you have a lot of time for the move to happen. Now let's look at the most important name of the day, Apple. You can see the rocket ship on the daily chart. The volume was over 92 million shares traded. That is way above average. When we take a look at the 15 minutes chart, we see the gap in the morning. The shares gapped, of course, about 5 to 6% on the heels of the earnings and the stock split news, but it traded flat for the majority of the day, all the way to around 11 o'clock Pacific time, 2 o'clock Eastern in the afternoon, when the stampede and the fear of missing out happened significantly. And you can see it was intense buying, and the stampede continued all the way to the close. This is expected, of course, when you announce a stock split here. There's a lot of confusion that will happen. I have heard anywhere from you have to buy now because when the stock split, you'll make more money, to hey, if you buy a stock or a share in Apple now, you will get 3 more for free for the 4-to-1 split. Of course, that's not going to happen. You're not going to get 3 more shares for free. This is not how stock splits work. Your position is going to stay the same. But of course, that didn't matter. It is all about psychology here, and the psychology was the fear of missing out. I want to reserve my seat here in Apple before the split and then take it from there. Whatever happens, happens. But let's reserve our seats in Apple before the split. And you see the stampede that happened all the way to the closing bell right in front of you in the 15 minutes chart. I released this tweet in the morning saying that yes, I was considering closing my position, but I will add to it the short position. When you're long, you want to average down. When the stock sells off, you want to buy to average your entry price down. When you are short, it works the opposite way. When the stock rallies, you want to buy or you want to add to your short so it can average up. And this is exactly what I did during the closing bell. I averaged my short up. That gives me more time and more probability of the trade being profitable in the long term. Of course, the stock rallied over 10% today. We're not talking about a small cap stock. We're talking about a giant behemoth that added over $1.5 billion to its valuation today only. Ask yourself, is selling a few more Macs and iPads worth $150 billion additional on the stock? It is not, but of course we'll see this mania for a little bit. But now the risk versus reward becomes in favor of the stock cooling off a little bit after this intense movement. And when you average your short up, you're putting yourself in the position where the trade can become profitable easier than just watching and not averaging up. Again, this is not a perma bear craziness kind of outlook. I'm not saying that Apple is going to crash to 100, bro, or to 200, or it's the end of Apple. I'm not saying that. I'm saying that the stock is very frothy, it's very bubbly, and now more air added to the bubble, making the scenario of the explosion of the bubble more likely. We're talking about a sell-off here of another 10-20% or more to the downside. And when you average your short up after a big move like this, the likelihood is you will make profits in the trade. I have no problem whatsoever being mocked in the short term and taunted. That's okay, but I have an outlook. I did the numbers, I did the forensics, and this stock will sell off and the air will come out of the bubble sooner or later. I mean, there's a difference between doing your homework, looking at the numbers, doing the ratio analysis on the earnings numbers, doing the growth analysis, doing the valuation, doing the modeling for next quarter. This is the kind of work that I do when I see an earnings release. I work on the numbers, I create models, I create analysis, I do my homework. I saw laziness among the analyst community and the commentator on TV. I saw a headline from Bloomberg saying that Apple sales in China accelerated. This is why the reason the stock is rallying. The sales in China was the most underperforming among all the regions. Yes, it grew a little bit, but it was underperforming compared to the US and Europe, Japan, Asia Pacific. And then, of course, I saw Jim Cramer, CNBC Jim Cramer in the morning saying, oh, it's all about the wearables. The wearables, people discovering the wearables. The wearables actually grew negative quarter over quarter, year over year. It deaccelerated. It wasn't the reason why Apple had the blockbuster earnings report. It was the Mac and the iPad. Please do your homework. At least look at the numbers before you talk. But of course, this will not matter in the short term. It's all about the split. The split mania will continue in the days to come. All right, so what do we have for next week? We have a few earnings. We will do another pre-earning review on Sunday. And of course, I will do my portfolio review during the weekend too. I was supposed to do that last week, but we'll do it now. We have earnings, we have updates. So I will do a portfolio review during this weekend. And in the next week, of course, we will look at the historical move in August. August usually is very volatile. It precedes September. September is the most volatile. So the expectation is that the VIX will pick up in August. How would that affect the SPY and the Qs and the movement in the larger sectors? What are we going to see now as a theme in the market? After the rubble, after the dust is gone from the big tech earnings, what is the main theme that we will see in the market? Is it going to be, again, momentum stocks versus value, the stay at home versus reopening, day after day, the yo-yo game? Or are we going to see a shift to big tech again? We're just going to buy big tech again. And of course, there's another scenario that we will see winners and losers. We saw a little bit of that today. Look at how Google closed. Google closed in the red. Apple, Facebook, Amazon closed in the green. Are we finally going to see a market that will reward winners and punish losers, regardless of what sector they're in, instead of this parasite market where names that are underperforming leech off the overperformers and the winners? Having winners or losers, that will be a new theme that we haven't seen in the market for a while, but we have to wait for the action for next week to see if that is the theme that we will see developing overall. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.